Welcome back to the Motivated Mind Zone. Glad to have you here. Today, we are diving deep into something really fundamental for anyone thinking about personal finance. It's this idea of an automatic wealth threshold. For years, we hear these huge numbers thrown around 5 million, 10 million for retirement. It feels almost impossible sometimes. But what if that moment, the real game changer, where the stress starts to fade and, well, your money starts doing the work for you, what if that happens much, much sooner? So this deep dive is about finding that specific point, not necessarily the set for life finish line, but the point where you stop feeling like you're constantly fighting for every single dollar.
Right. Where your assets actually take over the heavy lifting.
Exactly. The analysts we looked at this week had this great analogy. They frame the early stages like pushing a massive rock uphill. It's constant effort, totally exhausting.
And if you pause for even a second,
It rolls right back down. Your net worth stalls or drops.
So our mission today, based on the numbers and the psychology and the research, is to pinpoint that net worth level. The spot where the rock finally tips over the crest and starts rolling downhill, picking up speed all on its own.
That's it. That's the shift we're talking about, moving from just surviving from that manual grind to real growth, exponential growth, potentially.
And the really surprising thing, the core insight here, is that this threshold, this automatic zone, it's often way lower, much more reachable than most people think. It's not necessarily about hitting that $1 million mark right away.
Oh, change starts earlier.
Much earlier.
Yeah.
And it's not just about the math, is it? The psychological shift is huge. People think it's just numbers on a spreadsheet.
But it's more than that.
It's realizing your money has achieved a kind of escape velocity from your own time and effort. But to really get that feeling of freedom, you first need to understand the grind, the struggle phase.
Okay, let's start there then. Under $50,000 in net worth. This is what the research calls the real struggle phase. Pretty much all your financial energy, your focus, it's just consumed by immediate needs. Covering bills, paying down debt, maybe trying to scrape together a tiny bit for savings.
It's incredibly defensive. And the weight of it, it's immense. There's just no cushion.
Right. Every purchase feels significant. Saving means making really painful choices, doesn't it?
Absolutely. You're actively trading off something you want now for something uncertain in the future. It's a constant battle of willpower against daily needs. And, well, willpower isn't infinite.
And the math at this stage, it doesn't really help motivate you, does it? Compounding isn't really visible yet.
Not in a meaningful way.
Yeah.
Say you've managed to invest $10,000, which is a great start, even if you get a fantastic 10% return.
That's only $1,000 a year.
Exactly. Which is nice, sure, but it's not changing your monthly reality. It doesn't suddenly make rent easier or cover your car payment.
The growth is just too small compared to the cost of living.
And this stage is so fragile. The research really highlights this. Any little thing,
Like a car repair.
yeah, a $3,000 car repair, an unexpected medical bill, maybe losing your job for a bit, it can completely wipe out months, maybe years of progress.
Ugh. Back to square one.
It feels like financial gravity is just constantly pulling you down.
So the goal here, it has to be about stability first. Defensive finance, like you said.
Absolutely. Build that emergency fund that's your moat, your protection.
And tackle that high-interest debt.
Oh, definitely. Credit card debt especially. Paying 18%, 25% interest, you're just running in place, or worse, falling behind. You have to stop the bleeding before you can even think about building seriously.
Get to a point where money isn't vanishing as soon as it comes in.
That stability creates the mental breathing room you need to actually plan for growth.
Okay, but things do start to feel a bit different once you cross that $50,000 mark, right? Heading towards $100,000.
Yes, that's the first really critical psychological shift. It's huge.
Why psychological?
Because it's the point where compounding stops being just a concept you read about and starts being something you can actually see happening, even with a modest portfolio.
Okay.
So let's say you have $80,000 invested, a pretty standard 7% market return. That's generating over $5,000 a year now.
Okay, $5,000. That's not insignificant anymore.
Right. It's maybe covering your utility bills for the whole year or, all those streaming services and software subscriptions we all have.
Or a car payment, maybe. Or a big insurance premium. Suddenly, that's being paid by your assets, not directly from your paycheck.
And that realization that $5,000 generated passively, it's profoundly different from the $500 or $1,000 you might have seen earlier. Doesn't mean you're rich, but it's undeniable proof.
Proof that your money is actually earning money. For the first time, maybe.
Exactly. You're shifting from being 100% reliant on trading your time for money
Or job.
to having this second silent income source,
Yeah.
even if it's small at first.
And seeing that validates all the hard work, right? All the sacrifices you made when you're below $50 K.
Totally. It proves the system works. And that proof, that little taste of passive income, it builds confidence. It gives you that momentum, that addictive feeling to keep pushing towards the next level where things really start moving.
Okay, so let's get into that next phase. This is where, according to the research, that automatic feeling really starts to creep in. If 50K, $100 was the psychological light bulb moment.
Then $100,000 and pushing towards $250,000 is where the momentum becomes, well, meaningful, visible, tangible.
Compounding isn't just a little helper anymore.
No, it's an active partner. Let's stick with that conservative 7% annual return figure the research uses, roughly the historical stock market average after inflation. At $100,000, that's $7,000 a year.
$7,000 just for owning stuff. Let's break that down, make it real for people listening. $7,000 a year is almost $600 every single month.
Mm-hmm. $600 appearing in your account passively.
Think about what $600 a month covers. For a lot of people, that's groceries. Or maybe your electric, gas, and water bills combined.
Right. It removes an entire category of worry. You look at your budget and think, okay, the investments handle the utilities this month. That separation covering expenses without using your active income, that feels incredibly powerful.
It really does. Now, this is where it gets interesting because the scaling should accelerate, right? But the source material had a number for $250,000 net worth that seems off initially.
Yes, this is important.
Logically, if 100K gives 7Ks at 7%, then 250K should give, what, $17,500?
Mathematically, yes, $17,500.
Right.
But the specific research we analyzed stated that at $250,000, the annual return only jumps to around $7,500 per year.
Which is barely more than at 100K. That seems like a mistake.
It's probably not a mistake, but it reflects a couple of crucial real-world factors that, deep dive audience needs to understand.
Okay, like what?
First, they might be using a very conservative real return figure. Maybe that $7,500 is after estimated taxes or after accounting for inflation more aggressively.
Okay.
The spendable passive income, not the total growth.
Okay, that makes some sense.
Second, and probably more significant, reaching $250,000 often marks a point where investors start to shift their strategy. They might become a bit more conservative.
How so?
Well, when you only had $50, maybe you were 100% in aggressive growth stocks. But now you have $250,000. Protecting that capital becomes more important. So you might diversify into bonds or other lower yielding but safer assets.
So the overall portfolio growth rate might actually slow down slightly because you're reducing risk.
Exactly. You're moving from pure accumulation, maybe taking higher risks, to a more balanced approach focused on wealth preservation alongside growth. So even if the gross return is higher, the safe, sustainable amount they're quoting as passive income is a more conservative $7,500.
Okay, that clarifies it. It's a reflection of changing priorities as the numbers get bigger. The core idea still holds, though.
Absolutely. The fundamental realization is that your wealth is now scaling much faster than your personal effort. You didn't have to work 2.5 times harder to get that extra income. Your assets did the work. You started to really separate your time from your earnings.
Which leads us right into what the research calls the automatic zone. While $100K is that first taste, The consensus range where wealth really starts to feel, well, automatic, where you feel genuinely cushioned by your capital, is usually between $500,000 and $1 million.
Right. Let's look at that $500,000 mark. $500,000. Using that more typical 7% gross return, again, just for comparison.
That's $35,000 a year, passively.
$35,000. Think about that. That's very close to the median individual income in the U.S.
Wow. So your investments alone are basically replacing a full-time job's income for many people without you working an extra hour.
That's the point where, for many, basic living costs can start to be covered by the automatic growth of their money.
And then, if you manage to keep that discipline and reach $1 million,
A huge milestone, no doubt. That $1 million, again using the 7% example, is generating roughly $70,000 a year.
$70,000 passively. Now, that starts to sound like real comfort for a lot of people, especially if you've paid off your house or live somewhere with a reasonable cost of living.
It's very comfortable money for a large portion of the country.
Okay, but I have to push back slightly here. 70K a year passively is amazing, but let's be real. In a high-cost city like New York or San Francisco, that's not exactly living large. How does the idea of automatic wealth fit there?
That's a fair point, and the research acknowledges this. It's not about defining automatic as luxury living for everyone. It's about optionality.
Optionality, meaning choice.
Meaning your basic needs, your survival, your core lifestyle is sustained without you needing to trade your time for money. Whether that level feels comfortable or wealthy absolutely depends on your spending and location. We'll dig into that lifestyle gap more. But the key thing happening psychologically at this $500K to $1 level is a massive shift in your mindset. The questions you ask yourself totally change.
How so? What changes?
Before hitting this zone, your main question is always about accumulation. How can I save more? How can I earn more? How can I cut costs? It's all about adding to the pile.
Right, offense.
Once you cross into this range, maybe $500,000 or more, you start playing defense too. The primary focus shifts towards preservation. How do I protect what I've built? How do I make sure this keeps growing safely? How do I minimize taxes and fees?
The urgency changes. You're less likely to chase those risky get-rich-quick schemes.
Exactly, because you don't need a miracle anymore. You've already built something substantial.
Yeah.
Now, the priority is avoiding big mistakes, staying disciplined, maybe optimizing things, and just letting time and compounding, which is now a powerful engine, do their work. It becomes a much less stressful, more strategic game.
So like you said, that 500K or $1 number isn't universal. It's a benchmark. But it's really important for you, listening right now, to think about what your personal threshold looks like based on your lifestyle.
That's the absolute key takeaway. The number itself is less important than what it does for you. Someone living very simply. Maybe they own their home. Their annual expenses are only, say, $30,000.
For them, $500,000 generating $35,000 passively is incredible.
It's game over, financially speaking. They have a $5,000 surplus every year without working. They feel, as the source put it, financially untouchable. They've achieved total financial optionality at that point.
But flip that. Someone with a huge mortgage in an expensive city, maybe 2 luxury car payments, expensive hobbies, kids in private school.
For them, even $1 million generating $70,000 a year might not feel automatic at all. They might still be relying heavily on their high-paying job to cover the other $100,000, $200,000 of their annual spending. They haven't achieved optionality yet.
So the real measure isn't the net worth number itself.
No. According to this analysis, the true measure of freedom is the gap, the space between what your assets passively generate and what your lifestyle actually costs.
The bigger the gap, the freer you feel.
Precisely. Lower expenses relative to your passive income means more freedom, a more automatic feeling, regardless of the absolute net worth number.
Which brings us back to discipline versus just income. It's not just about earning more.
Not at all. Discipline is paramount. We all know stories, or maybe even are those stories, of people earning huge salaries, $500,000 a year, say.
But they spend $490,000 of it.
Right. They are incredibly financially fragile. One missed bonus or a job loss, and their whole world collapses. That's lifestyle creep in action. It's the enemy of building automatic wealth.
And the research strongly supports this. Someone earning an average salary but who's incredibly disciplined, saving 15%, 20% consistently for decades.
They can blow past that $500 automatic threshold years, even decades, before the high earner who lets their spending inflate right alongside their income. Consistency beats high income when it comes to building sustainable wealth. It's just math.
Okay, let's quickly recap that feeling of momentum again because it changes so much depending on where you are.
Yeah, visualizing it helps. Below $100,000, it feels slow, like pushing that rock uphill.
Yeah.
Very manual. Progress feels tiny.
$100,000 to $500,000. Okay, now it's speeding up. You've crested the hill. Maybe you're on a slight downhill slope. You still need to guide it, maybe push occasionally. But the assets themselves are adding noticeable momentum.
Past $500,000. The psychological shift is usually complete here. The rock is rolling mostly on its own power. Your job becomes more about steering, maintaining, maybe tweaking things. But the heavy lifting is done by the assets. The inertia is real.
And then, past $1 million. Compounding is firmly in charge. If you're reasonably prudent, your net worth can genuinely grow faster than you spend. That's that true exponential curve taking off.
So how do you actually build that engine to get there? The analysts really boiled it down to three core non-negotiable principles. You need all three: earn, save, and invest.
Earn. And it's not just about the salary number, right? It's about the gap.
Exactly. Earning needs to create that space, that surplus, between your income and your expenses. That gap is the fuel for your wealth engine.
If you make $60 and spend $60K,
Your engine is stalled, no fuel. But if you make $100 and manage to live well on $60K, that $40,000 gap is powerful. That's $40,000 you can pour onto the fire each year, accelerating you towards that $500K earn much, much faster than someone relying only on 7% returns.
you need fuel. Okay, then save. This seems obvious, but it's where people often trip up looking for perfection.
Right. They agonize over having the perfect budget or saving strategy. The research emphasizes consistency over perfection. Just sticking to a solid savings rate, say 10% to 15% minimum of your gross income, ideally more year in, year out, that's the unsung hero.
Boring, but effective.
Incredibly effective. People waste so much energy trying to time the market or find the next hot stock. But simply automating that 15% savings every month, month after month, that's what builds the actual capital base that compounding can then work on. You need something to compound.
Makes sense. And the third piece, invest.
And here, the biggest lever you have, especially when you're starting out, is time. Time in the market.
Not timing the market.
Definitely not timing the market. The power of starting early is almost impossible to overstate. The research often uses examples like this. Imagine someone saves $500 a month starting at age 25, but stops saving completely at age 35. Just 10 years of saving.
Okay.
Compare that to someone who starts later, say at age 35, saves the same $500 a month, but does it diligently all the way to age 65. That's 30 years of saving.
So 10 years versus 30 years of saving.
Right. The person who started at 25 and only saved first 10 years often ends up with significantly more money by age 65 because those initial contributions had an extra 10, 20, 30 years to compound. The growth on the early money becomes the dominant factor. The later starter, even saving for much longer, struggles to catch up to the sheer power of that early compounding. Time is your most valuable asset.
Start early, stay consistent. Okay, one more crucial point here. The net worth trap.
Yes. This trips people up. Not all net worth is created equal, especially when we're talking about that automatic feeling.
People calculate their net worth, and often the biggest number is their house, their primary home.
Right. And home ownership provides stability. forces savings via mortgage payments, potentially appreciates. Those are good things. But
It doesn't usually generate cash flow.
exactly, the house you live in is fundamentally a consumption item. It costs money every month: property taxes, insurance, maintenance, repairs, maybe mortgage interest. It can easily cost 1 to 4% of its value each year just to maintain. It's a cost center.
So for that automatic feeling, for financial momentum, you need assets that actually produce income.
That's the key distinction. We're talking about things that generate cash flow whether you show up to work or not. Diversified stock portfolios paying dividends, bonds paying interest, profitable rental properties, actual investment properties, not your vacation home, or maybe ownership stakes in cash flowing businesses.
Those are the engines that create that $35,000 or $70,000 passive income stream we talked about. That's what makes wealth feel automatic because it covers your life costs independently of your job.
All right, so we've gone through the numbers, the mechanics, from the struggle zone up past a million. But there's a deeper lesson here, isn't there? Something the research really hammered home.
Oh, absolutely. It's probably the most important takeaway. Wealth doesn't just suddenly feel automatic because you hit a specific number on a spreadsheet.
It's not just the destination.
Not at all. It feels automatic because of the person you had to become to get there. It's about the habits,
Hmm.
the deeply ingrained discipline you built during those years of struggle and steady accumulation.
That's powerful. So by the time someone reaches $500,000 or $1 million through their own efforts, they haven't just accumulated money. They've fundamentally mastered certain behaviors: consistent saving, resisting lifestyle creep, making rational investment decisions, living below their means. The net worth number is almost just the scoreboard reflecting that internal transformation.
It's like the habits are the automatic wealth generator.
In a way, yes. This is the paradox people miss. They want the feeling of automatic wealth, the freedom, the lack of stress, but they look for shortcuts. They want the outcome without the process.
The magic bullet investment, the high-paying job that lets them skip the discipline saving part.
Right. But the research suggests the two are inseparable. You can't really achieve sustainable automatic wealth without forging the discipline required to build it in the first place, because it's that very discipline that protects you later
Protects you from what?
from blowing it, from letting lifestyle creep erode your gains, from making panic decisions during market downturns, from thinking a temporary windfall means you can stop being careful. The habits you build are the immune system for your wealth.
Okay, so let's talk about the reward for all that discipline. The freedom of optionality. What actually changes in your life when you hit that threshold?
The pressure fundamentally shifts. The gnawing anxiety about basic survival just evaporates.
You stop worrying about losing your job tomorrow or how you'll pay an unexpected bill.
Largely, yes,
Yeah.
because you know your assets are generating enough income to cover your core needs. That baseline is secure.
So your mental energy gets freed up. What do you focus on instead?
Your questions move up Maslow's hierarchy, essentially. They become more strategic, less about survival. How do I preserve the purchasing power of this wealth against inflation? What's the most tax-efficient way to pass this on? How can I optimize growth without taking stupid risks?
It's a different class of problem.
A much better class of problem. Money transforms from this source of constant, maybe even crushing, pressure into what it should be: a tool, a quiet, reliable tool that supports the life you actually want to live.
Knowing that income is flowing in the background, regardless of your job, that must change your relationship with work itself.
Dramatically.
Mm.
And this leads to the ultimate freedom. Reaching the automatic threshold doesn't necessarily mean you stop working. That's a huge misconception.
People think financial independence means retire immediately.
Right. But the analysis shows most people who build this kind of wealth don't just stop working, especially if they hit it relatively young. They continue working, but the reason changes completely.
How so?
They're no longer working because they have to, solely for the paycheck. They're working because they choose to.
Work becomes optional.
Truly optional. That gives you incredible leverage. You can walk away from a toxic boss or a soul-crushing job without fear. You can negotiate harder for better conditions or pay. You can take a lower-paying job you're passionate about. You can start a business knowing you have a financial cushion if it takes years to become profitable.
The power shifts back to you.
Completely. The goal isn't necessarily stopping work forever. The goal is the absolute certainty that if you needed to stop or wanted to stop, your lifestyle could continue, sustained by your passive income. That choice, that power of optionality, that's the real
And
price.
getting there, it's never an accident.
Never. The research is clear. The people who successfully reached this level did it intentionally. They systematically avoided the traps that keep most people stuck spinning their wheels.
We mentioned them before, but they bear repeating.
Absolutely. The big three villains: rampant lifestyle creep, eating every raise, getting bogged down in high-interest consumer debt, and the mistaken belief that just earning a high income is enough.
Income is just potential. It needs to be converted into assets.
Precisely. They focus relentlessly on building those income-producing assets, often quietly, without needing flashy displays of wealth. And because they built the right habits on the way up, by the time they crossed 500K or $1 Mallards, they had the discipline baked in to sustain and grow that wealth and the freedom it provides long term.
Hashtag tag out trap.
Okay, so let's wrap this up. Synthesizing this deep dive, the practical answer we found in the research to what's the automatic wealth threshold seems to land somewhere in that $500,000 to $1 million net worth range.
Yeah, depending heavily on your personal lifestyle and where you live. But somewhere in that zone, compounding typically shifts from being a theoretical concept to a real, tangible force that starts covering significant parts of your actual living expenses.
And the encouraging part, I think, is that the research suggests this level is way more attainable than people might assume. It's not about needing some secret stock tip or winning the lottery.
Not at all. It really boils down to consistency and patience. Diligently applying those three core principles: earn a significant gap between income and spending, save a decent chunk of that income consistently, and invest that savings early and often, letting time do its work.
It's about shifting your whole approach, really, moving from just trading time for money to designing a system where your money starts working for you, eventually harder than you do.
hmm Which leads perfectly into our final provocative thought for you to take away today. We spent a lot of time talking about the threshold number. Is it 500K? Is it $1 on it? But remember, the research implies the true milestone isn't hitting a specific net worth figure.
What is it then?
It's reaching the point where your money, through compounding and investments, is growing faster on its own than the amount you're adding through your own effort and savings. The rate of growth becomes the key indicator.
Ah, the crossover point.
Exactly. So the question for you is, how does focusing on that growth rate, the speed at which your wealth engine is running, rather than just the total number, change how you think about your investments, your savings discipline, and your consistency starting today? What's one small adjustment you can make right now to maybe accelerate that momentum just a little bit?